Well, ladies and gentlemen, good evening, and very warm welcome to you, and particularly tonight, after a very busy day with the autumn statement and having to comment on all of these very important matters and to cheer us up. We're very pleased that Matthew Hancock has been able to come and join us here tonight. We're very grateful, Matt, for that. Now, Matt has many achievements of which he may be justly proud. He's got a degree in PPE from Oxford and a master's in economics from Cambridge. That's what one might call a hedge. He's worked as an economist for the Bank of England, and then as a senior economic advisor and chief of staff to George Osborne. Last year, he was elected as MP for West Suffolk, following which he was elected to the Public Accounts Committee and also to the Committee on Standards and Privileges that adjudicates on MPs' conduct. He is rightly tipped as a rising star of the Conservative Party. However, possibly more important than any of these, if that's possible, is the fact that Matthew holds the record for playing the most northerly recorded game of cricket in history, somewhere within the Arctic Circle, I believe. Now, cricket is one of those Marmite sports. You either love it or you hate it, or as we've all been amused to see it all spilled over one of the motorways today. And Matthew's clearly in love group. He not only holds this record, but is also joint secretary of the Lords and Commons Cricket Group. But cricket is more than a sport. It's an idea that offers me a nice link into the topic under discussion tonight. If there's one thing people know about cricket, whether they love it or hate it, it's the phrase, "It's just not cricket." It's a short phrase that trips off the tongue very easily. But into that short phrase is packed a myriad of ideas and assumptions that are both highly important and much needed. As everyone knows, the phrase, "It's just not cricket," is shorthand for something like, that kind of behavior is just wrong. It's dishonorable, it's dishonest, it lacks integrity, it lacks decency. Cricket, like most sports, has many laws, but the phrase, "It's just not cricket," is not a legal one. It's a much softer, a subtler cultural phenomenon. Now, no one should imagine that this makes it less important. Quite the contrary. It is precisely those subtler cultural phenomena that make the game what it is. Well, the spot-fixing scandal this year reminds us, as if we needed reminding, that cricket is not cricket anymore. But if cricket is not cricket anymore, then neither is finance, and dare I say it, is a much more serious problem. And I think we want to be quite clear. I'm not suggesting that finance was ever a spotlessly honourable profession, nor am I suggesting that we need to return the city to an Edwardian period in which my word is my bond was all that you ever needed, largely because most people came from a very thin strata of society. But what I am suggesting, and have been in these lectures, is that we cannot hope to run a secure, efficient, or sustainable finance sector if we fail to realize that we need unwritten laws of conduct, basic human values, just as much as we need written ones in the form of regulation and legislation. We need the softer, subtler cultural values of honor, honesty, integrity, and decency, at least as much as we do effective legislation. We cannot possibly hope to develop a safe, growing, and a sustainable economy without properly understanding that humans are moral beings just as much as they are financial ones. Put another way, we're liable to repeat history unless we seek to understand human nature. I'm currently working on an initiative at the invitation of the Bishop of London to connect finance and ethics. There is an important dialogue to be had, connecting not only those that are camped outside St. Paul's Cathedral, but also the many people working within the market economy who are as concerned by the need to connect the market economy with its underlying moral roots. And people ask me why we need regulation rather than trying to bring about a change of heart through individual conscience. I'm reminded of Martin Luther King's remark. He said, "I admit that laws will not change hearts, but they will prevent people from being heartless. All of which leads me to Matthew and to his important new book, Masters of Nothing, which I highly commend you. Because what Masters of Nothing argues is that economic behavior is underpinned and shaped by human behavior. It argues that human behavior is not as rational and as logical as sometimes we might like to think. And it insists that unless we understand human nature and behavior as it really is, and not as we like to imagine it, we are liable to repeat the severe financial crashes that we have seen. Businesses do not act in a moral vacuum, Matthew writes in his introduction. Whether legal or not, immoral actions within businesses should not be ignored just because there's a logo on the door. Given that my overarching theme in this year as Gresham Professor, and indeed in the other lectures, is that we badly need to reconnect the ethical with the financial, you'll not be surprised to say that I would be soundly in agreement with that statement. The question, of course, is what we can do about it. I know Matthew has some intriguing and important answers to that question. And for me, the really exciting thing about them is that they are grounded not only in the desire to understand human nature, but in the recognition that we need a realistic understanding, and not one that is satisfied by the myth that we are all narrowly rational financial automatons. I look forward greatly to hearing what Matt's got to say to us this evening. Do you want to give him a warm hand?
Well, thank you very much, and I think that it's a great pleasure to be here and to be here under your professorship, Ken, because what you are exploring and arguing in this in your series of lectures is very close to the nub of what I've been trying to work on also in the book that we launched 2 months or so ago. I'd also make one remark about the cricketing analogy that you drew, which is that, of course, laws are crucial to a sound framework in which either we play cricket or in which a market operates. But the softer spirit of it's not cricket in your phraseology, or the spirit of the game as well as the letter of the law, does also have real effects, as was demonstrated this summer when, according to the law, one of the England batsmen who'd scored over 100 runs was out. But it was quite clearly a mix-up in terms of whether tea had been called. And that, in honouring the spirit of the game, the Indian team called him back in and withdrew their appeal, which fitted, I think, the culture of cricket, even though it was technically within the rules to dismiss him. And that was a concrete example in the most intense crucible of international cricket, of the importance of culture and ethical standards and the spirit of the game of cricket, impacting very directly on what happened within the rules. This interaction is crucial to understanding how we might solve some of the problems that we face in capitalism today. And I want to address today a very simple and clear question, which I think is well motivated by the events around us, but is also a motivator of the need to reform the free market capitalist system in which we work. And this is an extension of the proposals in Masters of Nothing, but I hope to explore it today. The question I want to ask is, how do we deal with rewards for failure without threatening growth? We meet, as we all know, at a time of great uncertainty for the global economy. I've come from the chamber of the House of Commons, where the Chancellor delivered his autumn statement. He is now at yet another meeting of Eurozone finance ministers, and I don't think anybody any longer underestimates the scale of the crisis or the scale of measures that will be needed to tackle it. But in looking at this crisis, we need to come to the right, not the wrong conclusions about the world that we live in and how to address the problems that we face. Like you, Ken, I am a loyal friend of capitalism. The free flow of global capital is as powerful a force in the 21st century as the invention of penicillin was in the 19th century. Anyone who doubts the power of capitalism to do good should look at the dark days of Middle and Eastern Europe when there was not enough, or at the economies of India and China, Indonesia, Brazil, Vietnam, where pro-market reforms have lifted more people out of poverty, ignorance, and squalor in the last 2 decades than any other policy in the history of the world. I am unashamedly optimistic about the rise of the East and its impact on us here in the UK, because it's an unprecedented opportunity for us to trade and export, and we should see the growing of the global pie as a positive and not a negative impact in the long term on the UK economy. But just as this has been going on in the East and the South of the world, so something has been going wrong in the West, the home of the free market. We have a debt crisis, of course, and that must be resolved both here and in Europe. But I want to look at something deeper. One of the most fundamental principles of free market capitalism, the very basis of its moral authority over socialism, has been ground down. I'm talking about the principle of just rewards, getting out what you put in. The idea that people should be paid according to the value of the work that they do. The debasement of just rewards has subverted the capitalist system, and we need to tackle it. It's been called the something for nothing culture. Economists call it rent extraction. I call it rewards for failure. And I think that it turns society against the source of its own prosperity, harms the economy, is unethical, and it needs a solution. In these difficult times, that solution cannot come in a way that undermines growth. Now is not the time for actions that stifle job creation and the support of prosperity. The idea that governments should pick between predators and producers, I think, is absurd. And for the state, for example, to set ratios of pay would produce some perverse and arbitrary outcomes. Under a pay ratio system, the managers of businesses which provide the most jobs could easily go unfairly penalised. For example, Tesco, which employs 13 times as many people, would likely be hit harder than Goldman Sachs. So I want instead to look at how we deal with the very real and very damaging problems of rewards for failure in a way that strengthens the position of the UK as a place to do business. I think that the problem of rewards for failure falls into 3 parts. It has a social dimension, an economic dimension, and an ethical dimension. And I want to come to each in turn. First, there's one line of argument that I would explicitly reject. I don't think that high pay in itself is a bad thing. Those that say otherwise are indulging in the politics of envy. I don't think any society can call itself free if it imposes a threshold above which people cannot aspire. And no economy can afford to be anti-wealth. Indeed, around the city, there are literally thousands of enterprising, usually small, innovative businesses whose success drives exports and growth, and whose failure wouldn't threaten anybody except their own money and that of their investors. They too can be affected by ill-informed criticism of the city as a whole that doesn't distinguish between entrepreneurs and those who are in charge with the safe stewardship of our largest organisations. Fortunately, I think that respect for wealth creation is deeply embedded in our culture. think about the moving tributes to Steve Jobs when he died. Jobs died worth an estimated $7 billion. But no one resented him for it, not least because the products that he created made life immeasurably easier for millions of people, including me. Then there's The Dragon's Den and The Apprentice, two of the most consistently popular TV programs on the BBC, both explicitly based on the profit motive. But the fact that the public are genuinely supportive of wealth creators is all the more reason to take concerns about rewards for failure seriously. So first, if I tackle the social dimension of the argument. The tent dwellers that you mentioned, Ken, at St. Paul's, I think they should long since have moved on, but their complaints are somewhat incoherently articulating just more aggressively what millions of others around the country feel instinctively whenever a story about executive pay appears in the newspapers. Some of the polling bears this out. 78% of those polled agreed that the growing gap between rich and poor was bad for our society. 83% agreed that excessive bonuses were one of the root causes of the financial crisis because they fueled irresponsible risk-taking. Even within the city itself, support for business, as usual, is weak. 63% of financial service workers in a survey thought that FTSE 100 directors are paid too much. 63%. So when, for instance, they look back and see the head of Northern Rock taking over a successful building society, presiding over the first run on a British bank in 150 years, and then departing with a $750,000 payoff and a pension top-up, as well as the cut-price staff mortgage, we can all agree that there is something wrong and a disconnect between business outcomes and the level of compensation received. And I think that we can agree that if executive pay disproportionately outstrips corporate performance year on year, then shareholders are behaving in a very strange way. This practical problem has political consequences. 68% are in favour of a financial transactions tax on the grounds that it would curb the culture of outrageous bonuses in the city, despite the fact that we know that such a tax will be hugely damaging, and if it was imposed unilaterally or by the EU, hardly anyone would pay it because the business would simply move offshore. So we need to tackle these problems whilst recognising the concerns of people in a way that is practical. Are the public right to perceive that there's a problem? I think that the statistics show some support. Pay rises are disproportionately accruing to those at the very top. Last year, FTSE 100 directors' earnings rose by a median of 16% compared to the private sector median of 2.6%. Top earnings are outstripping long-term corporate performance. Across the FTSE 350, boardroom earnings have increased by over 100% over the past decade. Bonuses, 187%, but at the same time, the year-end share price has fallen by almost 3/4 on average across the FTSE 350. And the effect of this is that it is to undermine support for free market capitalism, which is seen to be rigged in favour of an unprincipled minority at the top. Those of us who recognise the power for good of capitalism must face up to these concerns and tackle them. So how do we start to restore public trust? One of the first things that we can do, I think, is try to make corporate boards more representative. When I was writing the book, I looked hard at the evidence that was presented to me about the impact of women on boards. And I became convinced by looking at the evidence that there is a systematic bias against the inclusion of women at the top corporate level. At present, 14% of FTSE directors are women and 9% of FTSE 250 directors. But the thing that persuaded me is that The research shows that not only does board performance, corporate performance, improve when there are more than 2 women on a board, but also the correlation between female CEOs and performance is very strong. And a McKinsey study found that of 89 listed companies with the highest level of gender diversity, operating returns were double the average. So there is a correlation. The causality is harder to explain, but there is enough evidence to make us seriously consider the concern. And when you look at the anecdotal barriers to female participation at board level, then you can start to see a cultural problem that I think needs to be tackled. So these are the social concerns around rewards for failure. But if we're going to tackle this problem in a way that supports rather than endangers growth and the position of the UK as a place to do business, then we need to look at the economics of it. The question becomes what to do. When you put the question of excessive corporate pay to top earners, the response is nearly always the same. Global businesses, they say, have to pay competitively in order to attract the best talent from around the world. That's a direct quote from Bob Diamond when I asked him exactly that question recently. It's an argument that's often heard. But the problem with the argument is you don't often hear it run anywhere else in a corporate entity. I don't often hear the argument from senior management that we have to increase the pay at a junior level in order to get the best talent. In fact, a competitive labour market tends to put downward, not upward, pressure on pay everywhere else in the business. Why does the logic of global competition for labour run in a different direction depending on the pay bracket of the labour in question? If the best talent from around the world really was being mobilised, then maybe we would expect top earnings to fall as they were competed downwards. After all, there are brilliant individuals in India and China who'd be willing to work for much less than their Western counterparts. We know they would. The CEO of the world's biggest bank by market cap, Hong Kong-based ICBC, earns $235,000 a year. The CEO of the Bank of China and CCB earn $229,000 each. Now, China has a very different culture, but each of these people are highly capable of running huge organizations just as big as their British counterparts for a fraction of the price. Would talent leave the industry? I doubt it as much as the fearmongers suggest. After all, ask a highly paid finance exec if they do the same job for less, and they usually struggle to avoid a smile. At the Treasury Select Committee, my colleague Jesse Norman asked Bob Diamond if he would do the job for nothing, and he couldn't deny it. So let's come back to this question. Why is in a competitive labour market, why is pay competed down at junior levels but up at senior levels? Why is it that management keep a grip on the costs elsewhere in business, but cost inflation, because that's what it is, happens to such a degree in this one area of senior executive pay? So as an economist, I then looked at the incentives on management. Managers' and shareholders' incentives are aligned when it comes to junior pay. Both want to hire the best they can for the minimum cost. But for senior executive pay, the incentive of management and shareholders is misaligned. Of course, good managers of large organisations consider far more broad things than just their own pay package when they're thinking of business decisions. But at base, their personal incentive in a narrow sense, when looking at senior executive pay, is that they want to pay more. So aligning the incentives of management and shareholders would be a good start. As an economic policy, as a change to a microeconomic structure, it's hard to argue against. This has already started to happen. The Bank of England's Financial Policy Committee recently warned banks that bonuses and other payouts must reflect any reduction in profits. There's also evidence that we need to consider that suggests that excessive pay fueled the creation of unnecessary financial products, which helped complicate and destabilize the financial system. When a new financial innovation is introduced, outsiders will often pay a high premium for the specialist knowledge needed to take advantage of it. This is the argument that we must pay well because this individual is one of only a few in the world who can do the job. It's an argument that you hear a lot at senior levels in banks. The effect becomes more extreme during a period of low volatility as investors scour financial markets looking for more yield. And the practice of securitization, I think, added to this. It directly contributed to the rise of bonuses. Because in a retail bank, where loans are kept on balance sheet, the performance of those loans can only be judged over a period of years after they're issued. And so it's the ex-post performance of a portfolio that can define, that determines performance and on which pay can be assessed. If you package up and then sell on a portfolio and then take a fee on the basis of that package, then you are defining that fee on the ex ante, the expected return on the loans, rather than the outturn. It's a bit like Toyota guessing how many cars they'll sell over the next 10 years and then booking the profits today. The result is that bankers can make a huge instant profit in one go in this market, even though they're selling products that may turn out to be worthless in the future. And of course, we saw this on a huge scale. The misalignment of incentives, I think, is important in another area too, which is broader than just the financial sector. And that's the strong link between CEO pay and the size of an institution. This is largely because shareholders have understandably, traditionally, reasoned that the larger the company, the greater the opportunity for the chief executive to add value. But it means that management almost always, has a strong incentive to ensure that a takeover goes ahead. This, in turn, can create a conflict of interest, as not all mergers add value for shareholders, and indeed, the recent history suggests that many mergers haven't added value as they were billed to. The interests, again, of management and shareholders are at odds. At the time of final sign-off of many large deals, it can be the case that almost everybody in the room is incentivized with a personal interest for the deal to go through. Now, corporate law, understandably, requires shareholders to take independent advice on takeovers. But supposedly independent advisors often themselves have incentives that are structured in favor of the deal going ahead. And of course, directors have a statutory duty to promote the interests of shareholders. But though these duties are written into legislation, they rarely provoke a challenge. And it isn't a surprise when we consider the behavior of large groups, and especially large groups without, I'm afraid to say, gender diversity. I'll give you an example. When groups get bigger than 3, the psychology literature demonstrates, I think pretty firmly, that groups tend to challenge less and bind together more. Those who speak out against the group's position tend to be ostracized and in some cases lampooned. We saw it over and again with those who predicted that the great debt boom would end in tears. But it's also true in a more real way. If you go mountain climbing, then please take my advice and don't go in a group larger than 3. Because the evidence shows that in groups larger than 3, more fatalities tend to happen. Psychologists found this result and were fascinated, so they looked into it. And what happens is that when the group if you go on your own, then you've got different problems. But if you go in a group of 2 or 3 and the weather closes in, the group dynamics are such, and the group's small enough, that somebody's prepared to say, the weather's turning in, we better go back. But in groups of 4 or 5 or more, the group dynamic and the group motive of trying to reach the top of the mountain overrides this consideration, and people are less likely to say that it looks dangerous and we should turn back. We all know this groupthink from our lives. When have we not piped up in a large group when the whole group wanted to achieve a certain goal, even though it was appropriate to do so? Now, in corporate governance, if directors fail to challenge, shareholders, of course, have the right to challenge too. But in practice, they very rarely vote down management. And their specific votes on pay, which are advisory, have, in the past, in some cases, been ignored. Now, the dynamics of votes at board meetings are complex, and the anticipation of a difficult vote can spur a board or management to act. But votes on pay that are advisory and then are ignored, I think, are a very bad signal, especially when one of the problems is the lack of shareholder engagement and shareholder voting that we see, especially because there is yet another principal agent gap between those who are holding the shares on behalf of the eventual owners of the capital, often in pension funds for millions of people who take no direct active interest in their ownership. So I think that votes on pay ought to be made binding. But I don't think this will be enough. Because while there is also an asymmetry of incentives, shareholders too suffer an asymmetry of information. How can we tackle this asymmetry of both information and incentives? In other areas of public life, I know very well from personal experience, where the public interest is involved, we have institutions to ensure that both sides of the argument are heard. In the House of Commons, we have an official opposition who is paid by the government, given a cabinet minister's salary, given a research budget, in order directly to challenge the proposals of the government. In other areas, in employment tribunals, a voice is provided to each side of the argument. And here we are in criminal law, public prosecutors make the case and others try to defend against it. So for these reasons, my co-author and I proposed the creation of a public protagonist with access to corporate books and who can present an independent case, call if necessary or speak at an AGM, and present the case as they see it on pay and takeovers. The aim behind this is to puncture the groupthink that can occur otherwise. Where there is doubt about the real economic value of a deal or of a pay structure, their task would be able to present the case to the board that the board didn't want the shareholders to hear in terms that they could understand. And shareholders, of course, would have no obligation to heed the advice. They, after all, own the company. But the managerial monopoly on the salient facts would be broken and a culture of challenge introduced. I think that one of the another way that the same goal could be established, that it could be achieved, would be through more and stronger transparency. And the government is consulting on whether transparency should be broadened, and I think that it should in a radical way. But that can tackle the asymmetry of information. But what about the asymmetry of incentives? I think there's that history plays an important part here. For a long period of time, in the merchant banks of the City of London and in investment banks across the world, the holders of capital were the same people as the senior management. These were partnerships. And returns accrued to partners, both for the capital that they had put in, and indeed the unlimited liability that often they faced, as well as their work and their labour in the company. When the partnerships were either bought up or floated, the returns nearly all continued to accrue to the same people, even though those people were now managers rather than shareholders. Often they also held shareholdings, but returns continued to flow to labour. And the returns of 50%, for example, of gross profits to management in performance-related pay is much, much larger in the investment banking world than in almost any other. And if a hedge fund, for instance, tried to pay out 50% of gross profits to the managers, the fund managers, then they would likely lose their investors because the large amount that they were taking out seems to be unjustified. I think this history has a part here. But we can't go back to the days of management and partners being the same, because the amount of capital needed to sustain the global economy is much, much greater. But there are ways that we can change the dynamics so that that concern about liability and about long-term investment is just as great. So I think that the system of bonus clawbacks that the FSA has introduced is very important, but I think we should consider extending it. And I think that we should, that most senior staff at regulated firms should have a significant proportion of remuneration held back for a number of years. Given that the average lifespan of a FTSE 100 CEO is only 3.5 years, holding payback is a fairly weak deterrent, and especially when there is a golden parachute for exit. But we need to find a way, and this is one, to ensure that management has skin in the game, that a meaningful proportion of their livelihood needs to be bound up with the fortunes of their company. Options are a poor substitute because they provide no downside. If the share price rises, the executive can cash in, and if it falls, he's under no obligation to buy. Options have been used quite a lot, but the psychology literature actually explains why they are a poor incentive. There is an effect called the house money effect that came from analysis of gambling. In casinos around the world, it's well observed that high rollers fail to quit when they're ahead because they don't think of recent winnings as theirs. They feel still that they're house money. Where the sense of a personal stake is weak, they become much less loss averse, and they take a much higher propensity to risk. And I think this is the effect with stock options. Therefore, we need to. How do we make sure that there is that they have money in the game? I think that COCOs, bonds that automatically convert into stock during times of stress, are an important step. I think Credit Suisse's decision recently to move in that direction is a positive one. Of course, if a bank ran into trouble, employees holding COCOs would experience the same sort of fall in value of their shares as other shareholders. And at the same time, they then contribute to capital levels. So I think these are a positive development. In a world of securitization, there's an especially strong case for replacing fees with debt. Traders in collateralized loans have little incentive to ensure their products are worth what the market claims, because they're paid their fees up front. But if the income stream was derived from the loan itself, they'd have much better reasons to perform the necessary due diligence. These are initial suggestions. Progress is already being made, but they are by no means the final word, and they're aimed to tackle the real microeconomic problems and support a strong and competitive business culture. And I just want to end on this, because finally there is a strong ethical dimension to this argument about fair pay. Not only because of the socially defined boundaries of what's acceptable, and because this is one of the primary drivers of human behaviour, but because we know that markets that lack a strong ethical framework become corrupt and impoverished. Just as a functioning market requires buyers to trust sellers, and capital and labour to work together, they require decency, mutual respect, and fair play. Regulation is important, but it's no substitute for improved culture. We also know from the financial crisis that the unbridled pursuit of rational self-interest is ultimately self-defeating because we are not rational. Where did it come from? This idea that business ought to be amoral, that anyone entering a boardroom could leave their conscience outside. Why did we come to believe that if something is good for the company, it must be the right thing by the economy and by society? In 1970, Milton Friedman famously wrote that the only social responsibility of business is to make as much money as possible. To libertarians, this proved the perfect justification of unrestricted plundering, irrespective of the consequences for society or the rest of the economy. But in their excitement, they neglected to finish Friedman's sentence, which reads like this: "It is the social responsibility of business to make as much money as possible." But he goes on, "While conforming to the basic rules of society, both those embodied in law and those embodied in ethical custom." This is Milton Friedman, the priest of laissez-faire economics, making an argument for the importance of ethical custom in the article which defined and described most eloquently the need for businesses only to make money. Far from being a manifesto for corporate greed, the essay is itself a moral defense of property rights and the principle of shareholder sovereignty within that culture of ethical behavior. According to Friedman, the only entity with a moral authority to spend other people's money in ways which prejudice their individual interests is government itself. Government is only justified in spending on these grounds because it has a democratic mandate. Spending shareholders' money in a way that fails to maximize shareholder value is a violation of the duty that Friedman was talking about. Ethical custom, as Friedman called it, is crucial to the framework of a free market. And rewards for failure subverts the very principle of private property itself. The libertarians' response may be to do away with the regulator altogether. The socialist response to this moral problem is to crush it with government bureaucracy at the expense of growth. That is why free marketeers must confront the problems of rewards for failure. For if we allow the current fear and mistrust of business leaders to fester, then the argument of the anti-enterprise, those anti-enterprise, begin to gain more traction. Instead, it should fall to us to restore the free market system that this country invented, and in a way that works for billions of people around the world. Thank you.
Matthew, thank you very much indeed. I mean, as ever, thoughtful, provocative, and you've clearly shown that you have given great thought to the topic that you've been dealing with. So, Matt very kindly agreed to answer some questions. Who would like to take the first? Yeah.
I'm Dick Rogers. I've come down from Birmingham to ask these questions. I'm not quite sure about other non-bank bodies, but a senior official of the Bank of England tells me that banks create money. And I've got a bit of a feeling that some of the bonus that is paid to senior people by banks is not money they've got from anywhere, but money that they have created. And I've asked you, and I'd be grateful for a reply. The idea that banks create money, I think, is one that really needs not to be brushed under the carpet. And I would love, collectively, to really get to the bottom of this in trying to, improve the ethics of the city. Because I think the Bank of England should be the only creator of money, that it should be able to give it to the government to spend on things that help us earn a living, as opposed to commercial banks creating money, which goes into a house price bubble, and not only 8% apparently into industry, which we really need to have a bit more money. Thanks.
Right, well, where to start? Of course, a central bank can only a central bank can create narrow money. But when you put money into a bank, it will go and lend that out to somebody else. And this circulation of money creates the broad money on which we all rely when we put our credit cards into a hole in the wall. And this system of banking, which has grown up over 400 or 500 years, has proved to be, how should I put it? I'll paraphrase Churchill and say the worst of all systems other than everything else that's ever been tried from time to time. And of course, the banking system therefore needs a management, and this is the fundamental basis for why it needs a regulatory structure separate from unleveraged institutions, because a bank bases its business on a relatively small base of capital with assets and liabilities much larger than that capital, and why it's crucial that, I think, we moved away wrongly from regulating effectively the levels of capital that a bank had to hold and the levels of leverage in the economy. And we're moving back to that in a fairly vigorous way. Indeed, I imagine that some working in banks would argue that we're moving there too fast. I don't think so. I think it's crucial that we have a stable and secure banking system, not least with everything else that's going on away from these shores. So fractional reserve banking is the system that's allowed private enterprise to flourish without the government being the only thing that can finance organizations. And I think this is it's a good thing, but it needs to be managed properly. And as for the payments out of those, out of that money, that the broader money that banks create, I think the innovation of the Financial Policy Committee at the Bank of England is one of the underreported reforms that's happened in the last few years since the banking crisis, because it brings together decisions about the regulation of an individual firm with the impact on the wider economy. And its statement in one of its early meetings that banks need to consider the impact on their capital of payments out, whether in bonuses or in dividends, and instead should look at the impact of that on its capital base, was a very important one, and I think it's perfectly reasonable for the authorities, for taxpayers through the authorities, to have a view on whether capital should be held to ensure that a bank is secure and can continue to lend in good scale to the economy, as opposed to pay that money out. So I think that you raise an important question, but a complete and radical overhaul of the system so that we didn't have, essentially didn't have a private banking system, I'm not sure would be consistent with the growth that we need to fund the economy, provide jobs and prosperity for the future.
Thank you. Roderick Flood, Provost of Gresham. A most interesting talk, if I may say so, and somewhat unexpected one in some senses, but The word that I don't think you really used at any point was inequality. Whereas quite a lot of your arguments, I think, would be very similar to those used by Richard Wilkinson and Kate Pickett in the Spirit level, arguing that inequality is in itself economically inefficient as well as socially inequitable. So I wondered, firstly, whether you would accept that argument. And I suppose the second question, if I may, comes to what you do about it. Surely the implication of what you had to say about Bob Diamond or others essentially being prepared to work for nothing is that the argument that higher taxation in order to reduce inequality might in fact have very few deleterious economic consequences. That you could actually, to put it in the words of the people outside St. Paul's possibly, you could soak the rich in a very rich society in order to reduce inequality and therefore enhance economic efficiency.
Thank you. I think that the distinction that you draw between equality of outcomes as a policy goal and rewards for failure as a concept is very important. I think that the argument that tackling inequality just because it's there is not something that I'd support or promote. I think that there's brilliant people who create enormous value for all of us and who are rewarded exceptionally well. And I think that not only is this the right, this morally justified if they have created value, it's also well supported, I think, by the British people. But it's also there's also a very practical reason to celebrate that, and that is that we want to create a prosperous society. And the injustice comes from those who take out more than they put in. And this is true, I think, it's also true at the bottom of society, but I think there are measures in place, pretty tough measures, to tackle that. We also need to make sure that we tackle something for nothing at the top. So I would draw a very clear distinction, and therefore I see punitive taxation as not as economically inefficient, but also as socially less justified. The 50p rate may be justified now when people are facing a pay freeze in the public sector, for instance, and we'll wait to see how much money it raises. But punitive, very, very high taxation is I think, ethically not justified because it catches those who create brilliance and affluence and prosperity for the world, as well as those who have rewards without the success which I think is required to justify it. Sir.
Hello, my name's Giles Fraser. I was going to ask you a little bit about the word growth that you used a number of times. And I suppose it's two questions that are related. The first one I'm pretty sure I know the answer to. Does your vision of successful capitalism require continual growth? And which I imagine the answer to that is something like yes. And then the next one is growth something that can be sustained indefinitely, infinitely? Is there a limit to growth? Is there some sense of natural limit to growth, or is growth something that's infinitely possible?
Yes and yes. I think growth is both desirable and possible, and it all comes down to productivity. As we as a group of 7-odd billion human beings work out how to do things better, which we do, whether here in the developed world where we have to, for the first time, work out how to do things better, or in less developed places where they have to, in the first instance, a lot of the things that they do is work out how other places do it better than them, and therefore improve their own prosperity that way and catch up. Either way, we thankfully are continuing to improve the way that we do things, and that productivity ultimately leads to growth. And of course, there may be significant bumps along the way in managing it, but that's where growth comes from. And I think that if you end up
And that's unlimited.
I think that human ingenuity is indeed unlimited, yes. And if you try not to have growth in a world where people improve the way they do stuff, i.e. productivity is positive, you end up having fewer and fewer people employed. And that is one of the things that we know doesn't sustain an economy, so or a society, indeed. So I do think that growth is not only a good thing, but it's also we can continue to improve the way that we live our lives and our living standards, even with the constraints which are the globe on which we live presents us.
Ben Grizzle, I work at one of the very popular banks in the neighborhood.
Hey, I'm a politician. So.
My question is about, I'd love to hear you elaborate a little bit more on the way that governments have distorted credit markets. And just to give a bit of background to the question, as you rightly pointed out, it's not banks that create money, it's central banks that create money. And more central banks are less and less independent and are driven by the extreme moral hazard of politicians, where if you figure that a CEO can merely lose his job and very rarely goes to prison, similarly, politicians that make massive promises for generations into the future may at worst get voted out of office, but certainly never go into prison, never lose their pension if their policies go wrong. And so that moral hazard not only has created a system where you're creating infinite money growth, or not infinite, but certainly explosive in the last generation money growth, but also has accelerated that velocity of money that you mentioned, because by being that borrower of last resort, the person that said, yeah, sure, we'll guarantee that we'll buy all of these mortgages, we'll buy all of these student loans, we'll buy all of these farm loans, at least in my country, in the prodigal colonial US. But that acceleration of the velocity of money was not so much generated by banks, so much as governments saying, yes, we will guarantee these end loans, and therefore have burned down their full faith in credit over the last 3 decades, as we should have learned from the failure of the gold standard in 1971, plenty of other things.
I don't think that our central bank here is anything other than rigorously independent. And I think that's a very important thing. But I certainly agree with you that the regulation of credit was flawed and needs to be changed, and indeed many of those changes are going through. On the central point about credit creation, the banks, whilst private, are a crucial part of the economic policy infrastructure, because they translate monetary policy into the effect on the ground. They are the transmission mechanism. And so this is another reason why they ought to be regulated in a different way to the rest of the economy. But did that regulation go wrong, and was that underplayed by regulators, the importance of banks as a transmission mechanism? Absolutely. I think they were seen as, that transmission was seen as automatic and never expected to fail in the way that it did, partly because many people thought that we'd tackled the fundamental problems of economic management, which was characterized more in the phrase "no more boom and bust" than in anything anybody else said. So, was there a problem? Yes. Do we need to deal with it? Yes, but we need to do it in a way that ensures that we have a stable management of credit in the future, and learn those mistakes from how things were changed in the past.
You've made some interesting proposals to address the issues that you've identified. I was thinking that there's a past Prime Minister of this country who said on reflecting his time in Parliament, that almost all legislation had the opposite effect to that intended. Would you like to comment on that in relation to your proposal?
Yes, I'm a strong believer in the law of unintended consequences. That understanding and the humility that has to give you is one of the reasons why I think we should only legislate when absolutely necessary on something, and why I've tried to drill into the microeconomic causes of some of the problems that we face, and why it's important not to reach for what may be attractive looking but unhelpful suggestions. So that is, it's very much with that in mind that I go through this exercise of trying to tackle what is a real and perceived problem in a way that responds accurately to how humans behave.
Cecily White, I work for Elizabeth Truss. I wanted to ask about your proposals for rectifying the principal agent problem. Clearly one of the biggest problems with voting arrangements is the dispersal of institutional shareholders who may be based overseas, sovereign wealth funds, and so on.
Yeah.
Under your system, you're saying there should be, clearly there's not much incentive for these huge shareholders to collect what may be very rarefied information to make these decisions, and at the moment they rely on advisory agencies. You've proposed a public protagonist. How do you see that public protagonist working? Would that be in every vote? You mentioned certain types of merger where there's an economic dispute. I just wondered if you could say more about that. And then on the point about linking remuneration to debt rather than fees to combat the problems caused by securitization.
Yeah.
I wondered if you could elaborate on what the mechanics of that change would be.
Well, on the second, the key is skin in the game. It is starting to happen more, and really it will depend on the individual circumstance, and I don't think I'm best placed to tell people what their contractual arrangements are. But there are several examples of how it can be done well, and indeed there are new banks springing up that that ensure that they take a piece of a deal that they advise on rather than taking a fee, for instance. And so I think that it's starting to change anyway. On the first point that you make, there are, of course, there are two huge voting proxies, and there are other much smaller voting proxies. I would argue that for some of the really very large institutional shareholders, it would benefit them to do the work on what votes are available, because at the moment they have the option of exit or ownership, and by choosing not to scrutinise votes, they choose not to partake in that decision-making process. But they own the company. They own the firm whose shares they own. I think there's several different ways to try to improve this piece. Some have suggested compulsory voting. That would. You've got to check for the unintended consequences of that. But certainly improving the role of voting is something that I support, and I think we should explore further. There were two more questions.
Very, very interesting talk. My name is Will Dawkins. I was particularly interested in your remarks about the responsibilities of boards. The question is, what's your advice to remuneration committees on how they deal with the big dilemma that you sketched out? So here is a committee of the main board staffed by non-executive directors who are typically paid less than 1/100th of the rate of the CEO and spend very little time actually working with the company.
Yes.
And they have to sign off remuneration packages with 2 points in mind. On the one hand, to pay market rates, insane though they may be, to retain top talent, and on the other hand, to deliver value to the shareholders. The shareholders will vote them down if they overpay for talent. They will also vote them down if they deliver subpar share price returns because they have underpaid for executive talent. So if you were giving some advice to the Remuneration Committee on how to square that one, what would you say?
Well, I don't think that there's been much evidence over the last couple of decades that paying much, much more, as has happened for talent, has led to that talent blossoming, if you look at the returns for the very shareholders that we're concerned about. So I think they should have some scepticism for that argument, just based on the facts. But also you raise something that's very important, which is that, of course, boards are the delegates of the shareholders in the closer scrutiny than the annual scrutiny that a shareholder can give of the management of the company. But they themselves are far, far less close to the company than management, paid much, much less by proportion, and themselves have much less, usually have much less skin in the game, because if you come off one board, you can usually go and find yourself another one. And one of the things that we talk about in the book is the importance of ensuring that incentives for boards are strong enough. For instance, if you think about the organisations whose failure can bring down the whole economy, and there's about half a dozen of them in the UK, the non-exec's ability to question the management is vital. And the argument that a non-exec couldn't possibly know everything that was going on doesn't hold water, because if they spent full time looking at and scrutinising that company, and they couldn't know what was going on, then the senior management couldn't know what was going on, because a non-exec and a chief exec both have 24 hours in a day and 7 days in a week. But that, of course, would require non-execs actually to spend time in the businesses that they're supposed to be, have a duty towards the shareholders of, and indeed be paid appropriately for it. So I think that changing that dynamic, the dynamic on the board, is really important. I think that we should be much tougher on failure in this area. Let me give you an example. As a politician, your agent at an election is responsible for submitting your return of expenses to the Electoral Commission. If he or she gets that wrong and is not only is benevolently negligent, then they can go to prison. So that means that when you're in a tight race and you're a couple of days away from the election and you've got a choice about whether you put out the final leaflet or buy that billboard space or whatever it is, it's the agent who says to the politician, my neck is on the line, so I'll make that decision. Now, having been both an agent in that role and a politician, I've had conversations both ways where the agent says to the politician, hold on, that's my decision. And as far as I know, no agent has ever gone to prison. That's not the point. The point is not to send political agents to prison. The point is that the shadow of a very serious downside sanction changes the dynamic of the relationship. And so we should be more open to having downside sanctions, especially in the running of our very largest and most our largest organisations that have the most impact on the wider economy should they fail. So I think this is a very important point. Now, the final question.
Could I put a point to you that in the last 50 years, one of the biggest problems has been promotion of easy credit. When I bought my first house, I had to put down 25%, and I couldn't borrow more than 3.5 times my salary. Not many years, only a year or two ago, they're offering 110% mortgages. There is no control. Every time I get a credit card bill, it says, you only need to pay 5%, it's a minimum amount. So The whole ethos of society today is urging people to spend money that they haven't got. And if you get that situation, just look at the difference between salaries and housing. In that 50 years I'm talking about, salaries of professional people have gone up roughly 20-fold. The price of the house I bought has gone up 100-fold. How much dead capital is tied up in property in this country? And everything has been pushed. The economy must grow, but it grows up in deflated values. Because the money today is only worth about 5 pence for a pound.
I can highly recommend my book, which I get the feeling that you'll enjoy from the question that you've asked. The Gresham lecture was first given in 1597, so the broad sweep of history which you invite me to address is one that this well adorns this institution. I think there's a lot in what you say, and it comes back to the very first question about credit creation and the need to make sure that we manage the balance sheets of our systemically important banks in a way that we haven't before. And because, in part, of as well as the macroeconomic effects, because also of the impact that that has on individuals and families. So I think that's right, and I think that we moved away from that with a belief that things would only ever get better, that house prices would always rise, that boom and bust had been abolished. Whereas we should recognise that the business cycle is derived from the inevitable interaction of large groups of people, that people are born to bouts of over-enthusiasm and pessimism, and that we should recognise that we are frail and flawed human beings, all of us, and we need to manage the economy to take that into account rather than trying to pretend that we are perfect, rational beings all of the time, because I certainly know that I'm not, and I'm sure that, well, I'm sure you are. Thank you.
Matthew, thank you very much indeed. It was very kind of you. Once again, can I just recommend that you hit Amazon as soon as you are allowed to get your BlackBerry open or whatever you have.
If you buy it from my publisher's website, Biteback, then you can pay at full price instead of the Amazon price as well.
Well, there we are. There's a very good commercial way of doing it. Thank you very much, and thank you very much for being here this evening.